Stay with us till the end for a special bonus tip you won't want to miss. Welcome to episode 12 of the Hidden History of Money series, where we cover the topic of Warren Buffett's greatest trade you've never heard of, still relevant today. Please remember to like, share and subscribe to our Finance Arcana YouTube channel if you like our content. Everyone knows Warren Buffett for his iconic investments. Coca-Cola, a timeless classic that has quenched the world's thirst for generations, sits comfortably in his portfolio. Apple, a tech giant that redefined the world with its innovative products and sleek designs. And of course, Berkshire Hathaway, the sprawling conglomerate that serves as the bedrock of his empire, a testament to his long-term vision. These are the names that immediately spring to mind when you think of the Oracle of Omaha. But there's so much more to his story than just these well-known successes. His investment acumen extends far beyond these popular choices. Beyond the household names and the blue-chip stocks lies a hidden chapter in Buffett's investment history, a story often overlooked in the grand narrative of his success. His greatest trade, the one that quietly made him over $4 billion in just 3 short years, is one you've probably never even heard of. It's a testament to his strategic brilliance, his ability to remain calm under pressure, and his uncanny ability to see opportunity where others see only risk and impending doom. This trade showcases the depth of his understanding of market dynamics. This wasn't your typical stock market play. It didn't involve a stock, a bond, or any traditional investment vehicle that you might expect. It wasn't even a company that he was betting on to turn around or disrupt an industry. This was something far more unconventional, a move that defied expectations and showcased Buffett's unique understanding of the market's underlying dynamics, his willingness to go against the grain, and his confidence in his own analysis. It was a calculated risk, but one based on sound principles. It was a bet on fear itself, a calculated and contrarian move into the very heart of a collapsing financial system. While others were panicking, desperately trying to salvage what they could and selling off assets at fire sale prices, Buffett saw an opportunity to capitalize on the widespread uncertainty and make a substantial profit. He recognized that fear, while often irrational and leading to poor decision-making, can create incredibly lucrative opportunities for those who are willing to act against the grain, remain level-headed, and see beyond the immediate chaos. This wasn't just luck. It was strategic foresight. So, how did he do it? What was this secret trade that generated billions in profit during one of the most turbulent periods in financial history, a time when even seasoned investors were losing fortunes? Stay with us until the end, and I'll show you a modern twist on this forgotten Buffett strategy. You can still use it every time markets panic, allowing you to potentially profit from the very same forces that cause others to lose money, potentially turning market downturns into opportunities for growth and financial security. If you enjoy uncovering the hidden plays of the world's smartest investors and want to learn more, like, share and subscribe to Finance Arcana. We're here to decode the forgotten trades, patterns and secrets behind money. The year is 2007. Subprime loans are collapsing. Wall Street is cracking. Banks are failing, one by one. The world is headed into a storm no one understands, except maybe one man. While others panic, Buffett sees opportunity. Not in stocks, not in gold, but in something far more strategic. Most investors were fleeing credit. Buffett? He stepped into the CDS market, credit default swaps. These were contracts designed to insure against debt defaults, a niche known only to hedge fund insiders. But here's the twist. Buffett sold these instruments, betting that the world wouldn't end, that corporations would survive, that panic it would eventually fade. Warren Buffett, a name synonymous with shrewd investing and unparalleled financial acumen, wasn't gambling when the financial world seemed to be collapsing around him. He was strategically playing the one advantage that retail investors often overlook, underestimate, or simply forget in the heat of the moment: time. In the midst of the crisis, when uncertainty reigned supreme and fear gripped the markets, he saw an opportunity where others saw only impending doom and irreversible losses. These credit default swap (CDS) deals that he engaged in, insuring against potential defaults, had remarkably long horizons, some expiring as far as 10 years out. This long-term perspective was absolutely key to his strategy, providing him with a buffer against short-term market volatility. While the rest of the world spiraled into short-term fear, panic, selling their assets at fire sale prices and making knee-jerk reactions based on emotion, Buffett, with his characteristic calm and unwavering conviction, bought time at a significant discount. He understood fundamentally that markets are cyclical, prone to overreactions, and that fear, while powerful and pervasive, is rarely permanent. It's a lesson in patience and perspective, a cornerstone of value investing. His philosophy, often quoted and deeply ingrained in his investment approach, is simple yet profound, a guiding principle that has served him well throughout his illustrious career. We simply attempt to be fearful when others are greedy. This contrarian approach, going against the prevailing sentiment, allowed him to capitalize on the irrationality of the market during times of crisis, buying low when everyone else was selling high. It's about identifying value where others see only risk. What was his underlying logic, the bedrock of his investment thesis? He reasoned that even in the face of a severe financial crisis, a period of immense economic hardship and uncertainty, the complete collapse of humanity and the global economic system was, statistically speaking, a low-probability event. He wasn't betting on Armageddon, he was betting on the resilience of the human spirit and the inherent drive for economic recovery. If the world didn't completely collapse and businesses continued to operate, albeit in a challenging environment, these contracts would eventually expire worthless. And if they expired worthless, as he predicted, he'd keep all the premiums he collected for insuring them. It was a calculated risk, meticulously analyzed and thoroughly researched based on a long-term view of economic resilience and the eventual return to normalcy. And that's precisely what unfolded, validating his strategic foresight and reinforcing the power of long-term investing. As the global economy gradually recovered, spurred by government intervention and the natural forces of market correction, and the initial panic subsided, the perceived risk associated with those CDS contracts diminished significantly. By 2011, just a few years after the height of the crisis, Buffett had made over $4 billion on the bet that fear was indeed temporary, a fleeting emotion that should not dictate investment decisions, and that optimism driven by human ingenuity, innovation, and fundamental economic principles was ultimately inevitable. His success serves as a powerful reminder of the paramount importance of long-term thinking, a disciplined approach, and a contrarian mindset in the often turbulent world of investing. It's a testament to the rewards of patience and the wisdom of seeing beyond the immediate chaos. What looked like a risky bet was actually the ultimate asymmetric trade. Limited downside, massive upside, if the world didn't implode. While hedge funds burned billions chasing volatility, Buffett monetized stability. He didn't chase momentum. He created a buffer of certainty and waited. Today, the intricacies of credit default swap desks might seem distant, almost exclusively reserved for institutional players with vast resources and specialized knowledge. But don't be discouraged. The core principles that drove Buffett's greatest trade are surprisingly accessible, and you can still effectively emulate them, adapting them to your own investment strategy and risk tolerance. The key lies in understanding the underlying logic, the fundamental relationship between fear, volatility, and value, and applying it creatively within your reach regardless of the size of your portfolio. Think of it as learning to play chess. You don't need to be a grandmaster to appreciate and utilize strategic thinking. 1. Buy when fear is overpriced. This is about identifying moments when market sentiment is excessively negative, bordering on irrational. Use indicators like volatility spikes, VIX surges, which reflect the market's anxiety levels, and widespread media panic, which often amplifies those anxieties, as your entry signal. These periods often present unique opportunities to acquire assets, whether they are individual stocks, ETFs, or even real estate at prices significantly below their intrinsic value. Remember, fear can be a powerful catalyst for mispricing in the market, creating temporary distortions that savvy investors can exploit. 2. Sell options or insurance when volatility is high. This is where you capitalize on elevated volatility by becoming the seller rather than the buyer of protection. Consider implementing option strategies like covered calls, where you generate income on stocks you already own, or cash-secured puts, where you get paid for being willing to buy a stock at a lower price. You could even consider selling volatility ETFs directly, although this is a more advanced strategy. These strategies allow you to generate income from the inflated premiums that accompany periods of market uncertainty. It's about being the house, not the gambler, collecting premiums rather than placing bets. 3. Invest in durable businesses at discount valuations. Buffett didn't just trade derivatives. That was merely one tool in his arsenal. He also strategically loaded up on fundamentally sound companies like Goldman Sachs, GE, and Bank of America. During moments of maximum market panic and widespread pessimism in 2008. These weren't just any companies. These were businesses he understood intimately, with strong balance sheets, proven track records, and solid long-term prospects, all available at bargain prices due to the prevailing fear. This is the essence of value investing, buying quality when everyone else is selling. Here's your takeaway. Fear creates mispricing, and that mispricing, if timed right, becomes your edge. During panics, sell volatility, cash-secured puts on solid stocks. Lock in premiums on short-term contracts, use time as your shield, and the crowd's fear as your fuel. It's not flashy, it's not fast, but it's how Buffett made billions quietly. And it still works if you have the courage to act when others freeze. Warren Buffett's genius isn't just in stock picks, it's in his ability to bet on long-term human resilience. And his greatest trade, the one few noticed, wasn't a gamble. It was a bet on us, surviving, rebuilding, and thriving. When you see the next panic coming, remember Buffett's secret. Time plus courage plus simplicity equals sign fortune. If this episode gave you insight into the mind of the greatest investor of our time, like, share, and subscribe to Finance Arcana, because we don't chase hype. We uncover the hidden trades that shape the future. Thank you for watching Warren Buffett's greatest trade you've never heard of, still relevant today. And as promised, that special strategy we shared is your bonus tip. Use it to profit from market panic. Stay tuned to our other upcoming episodes of the Hidden History of Money series.